When you monitor the stock market regularly, you know that sometimes the market goes up and sometimes the market goes down. You'd hear the anchors or analysts on Bloomberg, CNBC keep quoting the so-called VIX, saying it's spiked to 30 or it's come down to unreasonably low to single digit. In this short video, I try to describe what a VIX is from a quantitative and to a less extent a trader's perspective. VIX is the volatility index, originally created by CBOE, Chicago Board of Exchange, back in 1993. The definition has evolved over time, with a big update in 2003 from using at-the-money to out-of-the-money options, and then in 2014 to including weekly options. But the underlying essential idea stays the same, which is to track the implied volatility of 1-month SPX options. It's worth emphasizing that it's derived from the SPX index options, so it tracks the implied volatility but not the realized volatility, which is based on historical movements of the price. With this definition, it reflects the sentiment of investors and traders and their expectations of market uncertainty in the following months. To give a more quantitative introduction of the index, let's refer to the official documents by the exchange. I won't describe this in too much detail, but I would like to point you to the right references if you are interested in a further understanding of the VIX. I put the two links to the two official documents here so you can download and review them yourself. There's a direct formula for the VIX calculation, which is the square root of the weighted sum of the variance of all the out-of-the-money options. No need to read the math too carefully here if you are not a quant modeler or heavily invested in quantitative finance. What one should understand is that it includes contributions from the out-of-the-money puts and calls, not the at-the-money options, which was what the initial VIX used when it was introduced back in 1993. Out-of-the-money options are arguably much more relevant in financial practitioning, so the update in 2003 was welcomed by professionals. Another point to note is that VIX is aimed to track 1 month or 30-day implied volatility, but the SPX options are sparsely distributed in time to expiry. So in practice, what a VIX uses is to take the near and next term options with more than 23 days and less than 37 days to expiry and apply a weighted average. If you are really interested in the math, I here put down the most relevant, more fundamental formulas, from which you can derive the formula we saw earlier, which shows how to calculate the time and also strike weighted variance. If you are curious, you can try to derive the formula earlier, starting with these two formulas. But for now, let's move away from the math with the understanding that VIX is really an indicator of investors' sentiment, of market uncertainty, the implied volatility. Imagine next week is the election with a 50-50 even chance, or tomorrow 50 out of the SP 500 companies are reporting their quarterly earnings. The implied volatility would likely be higher than usual. Although, of course, in reality, most of the time, the spikes of the VIX are triggered by something bad that's already happened, which then serves as an ominous sign that something possibly even worse is coming. In any case, when the VIX is high, it means investors and traders believe there's a lot of turbulence coming, so the VIX index is indeed the fear gauge. Looking at the history of the VIX index level the last 2 decades after the burst of the 2000 dot-com bubble, there was 2 major spikes. One was due to the 2008 subprime mortgage crisis, and the other, the 2020 COVID-19 pandemic, which the VIX index spiked to over 60 and higher in both cases. Zooming in on the last decade, we can see many more, though smaller spikes. We can associate these spikes with the events that trigger the fearful sentiment. In 2011, the debate about US debt ceiling triggered the US debt downgrade. In 2012, the Greece debt crisis spread to the whole EU. There's a broader market sell-off in 2015 and 2016 due to a series of events, notably the unpacking of Swiss franc from euro in January 2015, and the GDP slowdown of China in mid 2015, and then the referendum of Brexit in 2016. 2018 is another year of turmoil after the strong performance of the stock market in 2017, caused by trade war and also the interest rate hikes from the Fed. 2019 was calmer, but in March 2020, the pandemic broke out and the market crashed by over 30%. There's a lot more to volatility and the VIX than those spikes and the lows in between. At least a few points here, which I will try to elaborate in the future in more depth. These points present a lot of trading opportunities with a variety of risk profiles or different levels of risk to reward ratios. First, volatilities tend to be clustered and can be modeled by the so-called autoregressive conditional heteroscedasticity or ARCH model. There's also derivatives of the VIX itself. The most popular and liquid ones are VIX options and futures. These derivatives can be used as hedging or speculative instruments by themselves. There's many trading strategies developed using these instruments. In particular, VIX carry, due to the mean reversion of the implied vol to expected long-term realized vol, provides a popular premium collecting trade. But also, it is one of the most dangerous trades too, particularly if it's highly levered. On the other hand, long volatility can be an alternative to using put options as a hedging mechanism for long equity positions. Volatility is a huge topic in finance in general. At the big banks and the funds, there's often a whole team or multiple teams dedicated to this specific area in various aspects. I hope this short intro gives you some fundamental understanding, and I hope you find it useful. Okay, thanks for watching and hope to see you next time.